You might get a $1,099K in the mail for selling a pair of shoes you forgot about, and the IRS could expect you to explain why that sale isn't a business loss. Sounds crazy? It's not. Starting in 2024 through 2026, reporting rules changed, and hobby versus business fights are getting louder. Stick around, I'll walk you through a 9-step checklist that side hustlers can use to prove profit motive, document losses, and survive an audit. Hey, welcome back to Tax Playbook, where W-2 earners with side hustles learn to keep more of what they make legally. Today's topic matters whether you flip clothing, sell digital services, or monetize content. I'll lay out a practical, year-round 9-step tax checklist to help you show your activity as a business, not a hobby, and how to document losses and claim deductions safely. Quick disclaimer before we start, this is for educational purposes and does not replace professional tax advice. Tax laws change. Consult a CPA or tax pro for guidance tailored to your situation. By the end, you'll have a clear, actionable file checklist you can start using today, plus real examples so you don't get tripped up by a surprise 1099-K. Let's start with the problem. The American Rescue Plan Act of 2021 changed the statutory threshold for Form 1099-K reporting down to $600 with no transaction minimum. That means, in theory, any payment platform generating $600 or more could send you a 1099-K. And many casual sellers could suddenly get hit with information returns. But here's the thing. The IRS phased in higher thresholds as a transition. Notice 2024-85 set the operational thresholds at $5,000 for 2024 and $2,500 for 2025. And the IRS indicated the $600 statutory threshold would apply starting in 2026 unless changed. Translation, more 1,099 seconds are coming, and you need records. 1099K is informational. It doesn't tax you by itself, but it does get matched against what you report. And mismatches raise red flags. If you're a casual seller who donated or returned items, or if a marketplace bundles personal transactions in the total, you must be able to explain and subtract those amounts with documentation. Okay, now the law. The IRS uses Section 183, the hobby loss rules, which is a fact-based, multi-factor test focused on whether you have a profit motive. There's no single magic checkbox. They look at things like, do you run it in a business-like manner? Do you have expertise? Do you spend time and effort? Do you expect profit? Have you made changes to improve profitability? And crucially, the 3 of 5 presumption. If you show profit in 3 of the last 5 years, that's a strong presumption of profit. Now, do you think posting a few listings or uploading occasional videos is enough to qualify as a business? Probably not. The IRS will look for patterns. You can have some personal enjoyment and still be a business. The key is whether profit is a primary objective, and you can point to objective efforts to achieve it. Time for the core, the 9-step checklist. I'll read them now and then unpack each with examples. 1. Choose an entity and separate finances. 2. Open separate bank and merchant accounts. 3. Start contemporaneous books, income, expenses, invoices. 4. Keep every receipt and a mileage log. 5. Track inventory and cost of goods sold for resellers. 6. Document a business plan and profit improvement steps. 7. Reconcile 1,099 seconds before filing. 8. Limit and document personal use or reimbursements. 9. Consult a tax pro if you get repeated losses or high 1,099 seconds. Quick tip. Step 1 doesn't always mean you need an LLC. For many side hustlers, Schedule C is fine, but separation of finances matters more than entity form early on. Let's dive into the first 3 steps in detail. Step 1. Decide whether to operate as a sole proprietor, an LLC, or another entity. Most side hustles start as sole proprietors on Schedule C, but if you're scaling or worried about liability, talk to a lawyer or CPA about an LLC or S corporation. Step 2, open a separate bank account and, if possible, separate merchant accounts. Why? It creates a clean transactional trail. If your personal Venmo and business Venmo are tangled, an examiner will assume the worst. Step 3, start contemporaneous bookkeeping. Use a simple bookkeeping app or a spreadsheet and record income and expenses as they happen. Record dates, payers, invoice numbers. Don't rely on memory at tax time. Later, I'll show exactly what to include in a profit motive file, one page, that could save you in an audit. Steps 4 through 6 are about evidence, receipts, inventory, and proof you're actively trying to turn a profit. Step 4, keep every receipt. That includes ad spend, shipping, software subscriptions, and supplies. Track mileage with an app. The difference between a deductible expense and a rejected deduction is proof. Step 5, for resellers, track inventory and cost of goods sold, don't guess. The IRS expects ending inventory calculations and COGS if you're selling products. That matters for gross profit calculations and showing you run the activity like a business. Step 6, document a business plan and your profit improvement steps. Examples: you raised prices after a cost increase, you tested paid ads, you launched a new marketing channel, you attended a trade show, you reviewed metrics monthly. Keep dated screenshots and notes. These show an intent to make a profit, not a hobbyist's pastime. If you've been losing money but you can show changes you made to become profitable, price raises, new sales channels, cost cutting that can be persuasive in an audit. Now the last 3 steps, and this is where the 1,099K trouble usually shows up. Step 7, reconcile 1,099 seconds before filing. If a marketplace sends you a 1,099K, including personal reimbursements or gifts, save emails or bank records showing the money wasn't income. Contact the platform for corrected forms where appropriate. The goal is to make your tax return numbers match your documented income. Step 8, limit and document personal transactions. If you use payment apps for mixed purposes, build a habit of making personal reimbursements identifiable or moving personal receipts off the business account. If someone reimbursed you for a cost, show the memo or bank transfer. Step 9, if you're taking repeated losses or your 1,099 seconds spike, consult a tax pro. Early intervention, amending a return, attaching an explanation, or establishing clearer records is easier than fighting an audit later. Coming up, 3 real scenarios showing how this checklist plays out: a reseller, a digital services freelancer, and a content creator. Which one struggles most with the hobby test? Wait until you hear the creator example. Scenario 1, Sam resells vintage clothes on a marketplace. In 2024, Sam had $4,200 of gross receipts on the platform and received a 1,099K. Under Notice 2024-85, platforms weren't required to report below 5,000 for 2024, but Sam still received other platform records, and a separate payment app issued a 1,099K for $700. Sam's issues were inventory tracking, COGS, and mixed personal sales. What Sam did right: a separate bank account, an inventory spreadsheet with purchase dates and costs, and photos plus listings stored on the platform. Sam documented that $200 of sales were from a personal garage sale transaction that should be excluded, and saved a bank transfer proving a reimbursement to a friend. Outcome: Sam reported gross receipts accurately, calculated COGS properly, and substantiated exclusions. If audited, Sam's contemporaneous inventory records and bank ledger told the story. If Sam hadn't tracked COGS, The IRS might treat gross receipts as 100% taxable with no way to prove basis, a big problem. Scenario 2. Priya sells digital marketing services on her own website and gets payments via a third-party processor. In 2025, she received a $1,099K for $2,700 from a payment platform, which under Notice 2024-85 was a reportable threshold for 2025 is less than #0.